In our last episode, we showed you how losses in the private credit market are hidden. Now, we're going to explain why they can't stay hidden forever. The private credit world didn't start failing because borrowers suddenly stopped paying their loans. It started failing because the system that concealed those failures was never built to handle movement. For years, the fog of fake stability worked because three things were true. Capital was patient, valuations were kept internal, and selling off assets was just a theoretical idea. As long as the money stayed still, you could manufacture time. You could rename defaults and push losses into the future. But private credit doesn't live in a closed room anymore. It has been quietly and deliberately wired into everything. Your 401k, insurance company portfolios, bank liquidity facilities, and even retail funds marketed as evergreen. Money that was once locked up for a decade now acts like it might need to leave at a moment's notice. And when capital starts to move, everything changes. Hidden credit problems don't just surface all at once. They leak out through withdrawal gates, delays, borrowing against portfolios, and sudden rule changes. What starts as a simple valuation issue quickly becomes a liquidity crisis. What looked like prudent management turns into outright panic. And what was marketed as long-term and stable is forced to confront short-term reality. This is the critical shift. Credit risk moves slowly, but liquidity risk moves fast. The fog doesn't lift gradually. It shatters when too many investors rush for the exit at the same time and find out that door was never meant to open. Today, we're not just looking at the collapse itself, but the mechanism that turns contained stress into a systemic shock. The amplifier isn't just leverage. It's the mismatch between who can leave, who can't, and who was told they could. Once that mismatch is exposed, this story stops being about private credit. It becomes about everyone connected to it. The biggest strength of private credit's its locked-up nature is also its greatest liability. In 2026, we'll see this play out. Imagine public stocks take a dip. On paper, private credit portfolios look perfectly stable, which makes them seem dangerously oversized on a company's balance sheet. This creates a quiet tension inside pension funds and insurance companies. Portfolio managers are watching their private credit assets hold steady at 100 cents on the dollar, while the rest of their investments are on fire. They aren't panicking. They're just doing the math. They know they're overallocated, they know the exit is blocked, and they know their liquidity has to come from somewhere else. The feeling is inti-fear-it. The uneasy realization that the most stable part of their portfolio has become the least usable. And because they can't sell their private debt, they sell what they can: stocks and bonds. The supposed stability of the private credit web forces the rest of the world to bleed. Remember the NAV loans we talked about, the ones linking private funds to the banking system? In calm markets, this connection is invisible. In 2026, it becomes a trigger. The sequence is mechanical. First, asset values fall as the fog lifts and models are adjusted. Then, margin calls arrive. Banks see the value of their collateral, the fund's portfolio decline, and they demand their money back. This leads to forced selling, as funds scramble for cash by trying to sell complex loans in a market with no buyers. The same leverage that once magnified returns now magnifies stress, feeding losses right back into the banking system at terrifying speed. For years, everyone crowded into the same safe bets, like software platforms and healthcare companies. In 2026, the real correlation is finally revealed. When one fund is forced to sell an asset to raise cash, it sets a real-world price. That price pierces the fog for everyone else. All those mark-to-market valuations evaporate in real time. Meanwhile, a retail investor checks their 401k app over morning coffee. They see a green arrow next to their alternative income fund. It feels like a win, a safe haven from the morning's headlines about market volatility. They don't see the withdrawal gate being prepped behind the scenes. They do not know their stable return is just a model that hasn't been updated. For them, the shock isn't the volatility. It's the moment the withdraw button stops working. When multiple funds try to exit at once, the system doesn't gently unwind. It snaps. The ultimate danger isn't just on a balance sheet. It's economic. Private credit is now the main lender to the middle market. If these funds freeze, the real economy loses its oxygen. Factories can't get working capital. Infrastructure projects stall. Small businesses can't refinance their debt. This isn't 2008. There's no single set of banks to bail out. Instead, policymakers will face a crisis of contracts. Thousands of private agreements that were never designed for emergency intervention. As you navigate the coming year, watch for these signals. The SEC is now focusing on valuation accuracy. Watch if payment in kind interest, a sign of zombie companies, spikes the moment a major evergreen fund limits withdrawals. You'll know the shock amplifier has been triggered. Risk can be hidden and it can be moved. But in the end, Risk always demands a balance sheet. Thanks for watching. Remember, risk wasn't deleted. It was rerouted to you.